The United States economy isn't just shaped in Washington. Some of it is quietly decided in Tokyo. And if that sounds strange, it should. Because the thing that's been holding parts of the global financial system together for the last 3 decades isn't a tech boom, or government policy, or even innovation. It's cheap money. Specifically, cheap money from Japan. And right now, that money is starting to disappear. If you've been paying attention lately, things haven't been adding up. The Federal Reserve talks about cutting rates, but mortgage rates barely move. Stocks look strong, until they suddenly don't. Financial conditions feel tight, even when policy says they shouldn't be. It feels inconsistent, almost random, but it's not. There's a system underneath all of this. Quiet, mechanical, easy to ignore. And it starts in Japan in the early 1990s. Back then, Japan was the second largest economy in the world. Its real estate market was so inflated that, at one point, the land under the Imperial Palace in Tokyo was said to be worth more than all of California. Then, the bubble burst. Asset prices collapsed, stocks fell, real estate cratered, and Japan entered what would later be called the lost decades. Growth slowed to a crawl. Inflation disappeared. Wages stagnated. It was like the economy hit pause and stayed there. So the Bank of Japan did what central banks do when they run out of options. They cut interest rates. Then they cut them again. Eventually, they pushed them all the way to zero. And when that wasn't enough, they went below zero. And then they did something even more unusual. They decided to control the entire yield curve, not influence it, control it. They effectively said, long-term interest rates will stay low, whether markets agree or not. And just like that, Japanese government bonds stopped behaving like normal assets. They paid almost nothing. Now imagine you're a Japanese pension fund or a life insurance company. You're responsible for billions of dollars. You need returns. You need yield. But your domestic bonds are paying you zero. You have 2 choices: accept no return or go somewhere else. They chose somewhere else, and that decision changed the global financial system. Because Japan didn't just invest a little bit overseas, it went all in. Over time, Japanese institutions became some of the largest buyers of US treasuries, major investors in mortgage-backed securities, significant players in global equity markets. Japan became, in effect, one of the world's biggest suppliers of capital. But the real engine behind this wasn't just investing, it was borrowing. Here's how it worked. An investor borrows money in Japan at near 0% interest. They convert that money into dollars. Then they invest in something that yields more. US bonds, stocks, real estate, anything with a higher return. After costs, they keep the difference. It sounds simple, and for a long time, it was. This became known as the carry trade. More specifically, the yen carry trade. And it scaled to enormous levels. Trillions of dollars, money flowing out of Japan, into the rest of the world, into markets, into assets, into risk. If it yielded more than zero, it was fair game. For decades, this worked because of one assumption: Japanese interest rates would stay low, forever. But in finance, the most dangerous word is forever. Because in 2024, something changed. The Bank of Japan began to step back. They ended their yield curve control policy, and for the first time in years, they raised interest rates. Then they did it again. It didn't seem dramatic at first, but markets reacted immediately. Stocks dropped. Volatility spiked. Japanese equities saw one of their sharpest declines in decades. And it wasn't just a reaction, it was a signal. The math had changed. Because when Japanese interest rates rise, 2 things happen at the same time. Borrowing in yen becomes more expensive, and hedging currency risk becomes more expensive. That easy trade suddenly isn't so easy. The profit margin shrinks. Sometimes it disappears entirely. And when that happens, investors do what they always do. They unwind. They sell foreign assets. They convert money back into yen. They bring capital home. This is called repatriation, and it sounds harmless, until you realize how much money we're talking about. For years, the United States benefited from being on the receiving end of this flow, a steady, consistent buyer of its debt, a source of demand that didn't ask too many questions. But what happens when that buyer steps back? To understand that, you have to understand something most people overlook. The Federal Reserve does not fully control interest rates. It controls short-term rates, the overnight rate. But long-term rates, the ones that affect mortgages, corporate borrowing, and asset valuations, those are driven by supply and demand. And demand matters a lot. The US government runs large deficits.
That means it constantly needs to issue new debt. Someone has to buy it. For a long time, Japan helped absorb a meaningful portion of that supply. Not because it wanted to, but because it had to. Now that pressure is easing, and when demand weakens, yields rise. Not because the Fed wants them to, but because the market requires it. Higher yields attract new buyers. That's the adjustment mechanism. But higher yields don't stay contained in the bond market. They ripple outward into everything. Take mortgages. Mortgage rates are closely tied to long-term treasury yields. If those yields stay elevated, mortgage rates stay high, even if the Fed cuts rates, which explains something that confuses a lot of people right now. Why borrowing still feels expensive despite talk of easing. Then there's the stock market. Valuations are based on future cash flows, and those cash flows are discounted using long-term interest rates. When those rates rise, the present value falls, even if nothing else changes. Earnings can be stable, companies can perform well, and stocks can still decline, because the math changed. Then there's corporate credit. When money is cheap, companies borrow aggressively. They expand, they invest, they take risks. When money is expensive, they don't. Activity slows, risk appetite fades, growth becomes harder. And all of this ties back to something deceptively simple: liquidity, the availability of capital, the ease of money moving through the system. For decades, Japan helped provide that liquidity, quietly, consistently. Now that support is being tested, and this is where the contrast becomes interesting. Because the narratives you hear every day focus on something else: inflation, AI, central bank policy. The usual headlines: loud, visible, easy to understand. But underneath that, something more structural is shifting. Something slower, less obvious, but potentially more important. Because this isn't about a single rate hike or a single policy change. It's about the gradual reversal of a system that's been in place for over 30 years. A system built on the assumption that cheap money from Japan would always be there. And maybe it still will be. Maybe the adjustment is slow, controlled, manageable. Markets adapt. They usually do. But maybe not. Because if that flow of capital continues to reverse, if one of the largest, most consistent sources of global liquidity becomes less reliable, then the effects won't be isolated. They'll show up everywhere: in borrowing costs, in asset prices, in economic growth. And the uncomfortable part is this: there's no single moment where this breaks. No obvious headline, no clear turning point. Just a gradual shift in the foundation. Which raises a simple question. If the world has been running even partially on Japan's cheap money for the last 3 decades, what happens when that money is no longer cheap?